and gentlemen, a very warm welcome to the Q1FY25 earnings call of Hinduja Global Solutions Limited. From the senior management, we have with us today Mr. Partha Disarkar, Executive Director and Group CEO, Mr. Winsley Fernandes, Whole-Time Director, HGS and CEO, Next Digital, and Mr. Srinivas Palakodeti, Global CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Darshan Mankad from Adfactors. Thank you, and over to you, sir.
Thank you, Rico. Good afternoon, everyone. We welcome you to the earnings call of Hinduja Global Solutions Limited for the first quarter ended June 30, 2024. Before we begin the earnings call, I would like to mention that some of the statements made during today's call might be forward-looking in nature, and hence it may involve risk and uncertainties, including those related to the future financial and operating performance of the company. Please bear with us if there is a call drop during the course of the conference call. We would ensure the call is reconnected the soonest. I would now hand over the call to Partha sir for opening remarks. Over to you, sir.
Thank you.
Partha, sir, may I...
Partha, we lost you, Partha.
I request you to unmute your line, sir. Ladies and gentlemen, the line for the management is disconnected. Please stay connected while we reconnect them. One moment, please. Ladies and gentlemen, we have the line for the management reconnected. So you can go ahead.
Thank you. And a very good afternoon to all of you who've joined the call today. And I am assuming that my audio is clear. Just do an audio check. Am I clear?
Yes, sir. You're loud and clear, sir.
Yeah. Okay, perfect. Thank you so much. So I also am assuming that many of you who are attending the calls also have our investor deck in front of you. We posted that on the website, and the first page of that gives the company at a glance. Some high-level numbers. Worldwide, we have about 18,000 employees in 9 countries. We have about 4,500 PIN codes that our digital media business covers across India, and about 1.2 million of broadband subscribers, 4.43 million of DTV subscribers, and about 5,100 rupees of net cash and treasury surplus. 4 lines of businesses, out of which the business process management service would be broadly classified into pure digital services, cloud, cybersecurity, data engineering, etc. And CX, which is business process, contact center, generative AI. So that's the business process management part of the business. Then we have the media business, which Vince represents, and he will come onto the call later. There is a broadband business there where we have network as a solution, home, wired, broadband, OTT, and IPTV. And we also have digital cable television, DTV, as the second arm of the media division of the company. With that, we'll move to the 5th slide out here. Snapshot of the financial performance. A slight dip in consolidated revenues, about 3.7%, and Para will cover that in more detail in his presentation. However, other income and total profit after tax has shown a very handsome increase from 11% to 870.9% respectively. Without getting into the numbers and details, which Pala will cover, we'll move into the slide 8, where I would try to tell you the key highlights of the business as we see it. There continues to be challenges in the macroeconomy with the volatility and delayed decision-making in key clients. As you know, the war is not helping. An election year and uncertainties around policy with a government change in UK, with an impending election in US, I think people are in a holding mode as to which way some key decisions, policy decisions will go based on the results of this election. So we are seeing delayed decision making in our clients. I would say that data analytics, social care, CCaaS, and cybersecurity have strong traction, and our UK business is doing better than expected due to revenues from key public sector clients. I'm also happy to announce that we've just made a small start in selling our digital services to UK and Australia. And as I had mentioned earlier, we planned to start off in South Africa. I'm happy to report that the South Africa office is now set up, completely ready to go, and we are expecting to start operations in the next couple of months. We have been spending money and investments in organic build-up of technology solutions to fast-growing sectors like technology, media, telecom, banking, financial services, retail, and consumer high-tech. And we have also now hired some vertical-specific sales leaders, continuing our efforts to strengthen the sales team, particularly in the Americas. You know that generative AI and large language models have created a lot of hype. It was unveiled in November 2022, and a large part of 2023 and 2024, the market continues to be very excited by its potential. We are also really enthusiastic about what it has as an ability to service and transform the CX industry. To be able to leverage that, we are investing heavily in building capabilities in artificial intelligence. We're setting up AI labs and are building models that leverage the existing generative AI tools and embellish them with the domain knowledge of our clients' businesses, particularly trying to redesign the customer journeys for our clients by trying to get into hyper-personalization, trying to develop conversational bots that learn based on call transcripts, and also building intelligent automation tools that use image and video processing. Happy to report that many of these developments are happening in-house, and we are also trying to build capabilities like other players. The good thing is that because this technology is new, nobody really has an edge over others. Everybody is trying to mine the same opportunities that are just evolved in the last 1.5 years. Our people, we have been able to hire a lot of very bright software engineers to embellish our team in digital talent, and that remains our focus going forward also. At the same time, we are also reskilling our existing 18,000 odd people that are there in a conventional CX business and trying to get them educated on digital tools. Slide 10 talks our vision to be the preferred digital transformation partner for the world's most admired brand. The light blue circle, which is bigger, talks about the entire customer journey and the customer experience, whereas the deep blue, smaller circle represents what we have done for the past 20 years. We have always been in the customer service, reactive space, and now we are expanding our horizon to cover web and mobile experience, e-commerce, generative AI, LLM-powered chatbots, CRM and custom insights, as well as digital marketing. Some of these newer capabilities have come through acquisitions, particularly the Elements acquisition that we did in 2018 and the TechLink acquisition that we did in February 2023. So our digital capabilities are much broader than they used to be in the first 2 decades of our existence. And that's how we hope to leverage the opportunity that has been thrown open by the developments in generative AI and large language models. The future state has been briefly pictorially represented in page 11. You will see again a light blue circle, which is the traditional CX. Today, that's about $330 million of our revenues. And the digital circle is the bright blue, which is about $92 million of our revenues. Going forward, the convergence of the two in the Venn diagram that we show is what we are calling digital operations. And that's where we will have AI-driven process management, AI-driven AI-supported unattended customer service using conversational chatbots or interactive voice response units, attended customer service, and AI ops, which is around creating models for data tagging and labeling. So that's the future, the convergence of our digital capabilities which are newly acquired and the traditional business that we have, CX business that we have done for the last 2.5 decades. What we are trying to do in the new plans that we are building for us is to change our revenue mix by lead through verticalized solutions. You would recall that we had a healthcare business earlier, and that was an extremely successful business. We are now trying to convert the rest of the business to similar verticals. The focus verticals are banking, financial services, technology, media, telecom, consumer packaged goods, as well as high tech. Our pipeline there is an effort to increase our pipeline aggressively, and that's why you will see that our expenses towards sales and business development has actually increased year on year. Our operating models are getting transformed. We're trying to go more offshore and build non-linear revenue models. And eventually, we would like to be a thought leader for AI-enabled conversations in our chosen domains. I will now hand over to Vince for a digital media business update. Vince, over to you.
Thank you, Partha. Thank you very much. And I hope everyone can hear me loud and clear. Can you hear me, please?
Yes, Vince.
Great. Thank you. I'm going straight on to slide 14. This is interesting in terms of the industry that we operate in, the media business. As you know, just for a quick summary, the media business comprises 4 verticals actually. The digital television business, which is the mainstay and the flagship. There is the wired broadband business, which continues. It is part of the sunrise industry and looks to continue to grow. It's barely crossed 38 million homes today. Of course, the third vertical is our tele-shopping and corporate sales business, and we also have a technology arm. So all these 4 have been positively impacted by the new business environment on page 14, where the regulator, the Telecom Regulatory Authority of India, has announced sweeping changes for broadcasting and cable. And I won't spend too much time on this, but just to highlight what are the critical aspects that kind of benefit us, I think if you look at the second block on the left-hand side, we're able to, which starts with saying in a bid to offer more attractive deals to consumers, DPOs like us, like Next Digital, we are now permitted to offer discounts while forming channel bouquets. So I'll explain the significance of this. Is pretty much important when you look at regional content. A simple example is why would the northeast of the country want to watch necessarily South Indian languages, and they'd rather prefer languages in their own local language. And therefore, we can look at forming channel bouquets that are of benefit to them. And similarly, vice versa, for those in the south, we can create bouquets and offer discounts for predominantly southern-based language channels. That is one. If you look on the right-hand side, this is a very good initiative for customers. That the duration of all prepaid subscriptions is specified in terms of number of days. You'll be happy to know that your company has been following this process for a long time. We believe in a very high level of transparency and governance, and we've been able to make sure that we follow this to the T. The other important thing, I think, is the last block, which talks about try issuing recommendations. Where there's everyone is concerned about DD free dish platform, which continues to kind of eat in to the customer base at the low end of the spectrum. With it becoming addressable, it obviously helps in terms of a level playing field as far as DPOs are concerned, besides obviously ensuring enhanced viewing experience and security. So it becomes, overall, the industry stands to benefit from these initiatives of the regulator that were announced just last month in July. That's on slide 14. On slide 15, as I've mentioned on several calls, our entire approach to business has been to leverage the investments that we have made over the last several, not just years, but over the last several decades. And this is yet another initiative that we've taken to leverage our capabilities. We have significant amount of infrastructure in cities like Mumbai, Delhi, Bengaluru. And while we launched Cellritics, as you know, last year to cater to the enterprise segment or the large-scale companies, this is a new model of providing services to the mediums, the micro, small, and medium enterprises, as well as SOHOs, small office, home offices. We're talking about lawyers' offices, chartered accountants. We're talking about pretty much every single business that needs to work from home. Is a small office or a home office operation, artists, everyone else that works from home, teachers, all of them. And this model called One Business, part of the One Broadband business, is mainly the main product is ensuring that we provide a strong internet lease line. And this is a dedicated, obviously, connection, because what's different from it and broadband? This is a dedicated connection to a company, to an MSME or a SOHO, and has much higher levels of service levels, or SLAs, right? Service level agreements, as we call, and there's a dedicated customer care team. So we've launched two products. One is Business Connect. If you look on slide 15 at the visuals on the right-hand side, we've launched one is Business Connect, and there's a Business Connect Pro. And we've already rolled this out, but as you know, we're always very cautious of our approach because we like to make sure our product is rock solid and robust when it hits the commercial market. So we're currently running a proof of concept in very high density markets of Mumbai, which has been, by the way, just to let you know, quite successful. And once it achieves success, for which we set the measurables, we look to roll out this product to the rest of Mumbai, of course, Delhi and Bengaluru. So that's on slide 15, the launch of our commercial broadband service. I'll take you to slide 16 now. Good, strong performance again. There was a marginal dip in terms of Q1 over the preceding quarter, but year on year, the growth has continued to be robust. If you look at it, we've grown about 15% as against Q1 of last year, and nearly 6% in terms of digital television, right? So the sunrise industry continues to make significant inroads in terms of growth. And even this marginal dip of 4.9% on broadband and 2% on DTV is really not a concern. We see this trend every year. And there are two reasons for it, which I've mentioned there on slide 16. One is that renewals in Q1, which is April, May, and June, are generally slow because of a lot of people going out on vacation, right? It's the summer vacation period in India, and renewals happen mainly in Q2. So we see towards June, middle of June, end of June, renewals coming in. So that is why digital television and broadband would show that. And we continue to ensure that the low-yield customers with a business that is looking to ensure profitability and on a path to profitability continues to show strength by ensuring the low-yield customers are churned. If you look at the two blocks of graphs below, which is broadband churn and DTV churn, this is very, very good. DTV churn, the average in the market is over 2.5%. In the first quarter itself of this year, we brought it down to below 2. It's a strong trend. And again, broadband, like I said, is more a question of renewals that we keep on seeing in Q2. So overall, the broadband and digital television subscriber base, we've continued to grow. Just to summarize, we've continued to grow year on year. More importantly, if you all have referred to the earnings data as well published, our revenues have continued to grow, and that is a very healthy sign. Our broadband base remains stable and robust, and Q2 obviously will see even a stronger performance, as well as BTV churn is well under control. Our new product rollout includes one business, as I mentioned to you, which is focused on SOHOs and MSMEs, and Cellritics continues to grow, catering to enterprises. This is a quick summary, and of course at the end when we wrap up, we'd be happy to take questions. So with that, I'm going to hand over to our global CFO, Srinivas Palakodaty. Srini, over to you. Pala, over to you. Thank you very much.
Thank you, Vince. Good afternoon, everyone. Thank you for joining us on this call. I just want to check, is my audio clear?
Yes.
Yeah, loud and clear.
Thanks. So I'm on slide 18 of the deck. This is the summary financial performance. As you would see, revenues have come in at about 1,092 crores for the quarter ended June of this year. On a year-on-year basis, compared to the quarter ended June of 23, revenues are lower by about 3.7%. And on a sequential basis, that is compared to the quarter ended March of 2024, revenues have come in lower by about 0.6%. So fairly flattish in terms of revenues. Small dip in rupee terms. Out of the 1,092 crores, around 72% of the revenues have come in from the BPM business and technology business, customer care. And the balance 28% have come in from the media business. At the EBITDA level, margins definitely do look low at 1.5%. As we have mentioned, there were certain one-off costs which were incurred in Q1 of this year, which resulted in the EBITDA margins coming down for the quarter. As I said, these one-time costs will not be there going forward. So we do expect margins to be definitely better as we go through the rest of the year. On a sequential basis, depreciation is fairly flat, and there's a slight increase in the interest expense of about 56.4 crores compared to 50.6 crores. And a bulk of the increase in depreciation is coming from Ind AS. There's also an impact on the interest cost. As I mentioned subsequently, there's actually been a reduction in the borrowings between March and June. At the other income level, there is a drop of about 23 crores between quarter ended March 24 and the quarter ended June. Though it is higher by about 11% compared to the quarter ended June 23. On a sequential basis, there is a drop primarily because in the quarter ended March 24, there were profits from sale of fiber-related and fiber optics by the media business. This is something which was called out when we came up with the results for the quarter ended March. And that was a one-off transaction. So the net result, other income is lower by about 23 crores between quarter ended March 24 and the quarter ended June. Coming to the PAT from discontinued operations, we have made necessary disclosures in the publication page. You may recall that we had sold our healthcare business in January of 22, and we had classified the healthcare business as discontinued operations. There was one final installment of funds which was to be received. So we have received that funds during this quarter, and this has resulted into net profits after tax of 218.5 crores. So for the quarter as a whole, total PAT came in at about 161.5 crores as compared to 16.6 crores for the quarter ended June of 23. So that's a growth of almost close to 10 times. And there was almost close to double compared to the PAT for the quarter ended March 24, which came in at close to 88 crores. Moving on to slide 19. This is the summary balance sheet. There is no change in the share capital. The buyback was completed in the previous financial year. The good part is our DSO days are down, so it has come down from about 62 days for quarter ended March 24 to about 60 days for the quarter ended June 24. And while it is coming up separately, there is reduction in borrowings of about 198 crores between March and June. And as you will see, the balance sheet continues to be strong, and we have total net worth of about 7,819 crores as of June of 24. Moving on to slide 20, this is the summary cash flow. Our cash flows continue to be strong, and from operations after taxes, we have generated about 348 crores during the quarter. On the investment side, as we have mentioned in our earlier calls, TechLink business continues to do well, and as a result of the performance, the sellers of TechLink were eligible for certain payments linked to earnout. So we did have that payment happening during the quarter. So that led to an outgo of about 127 crores. As I mentioned, there is reduction in our borrowings during the quarter. And if you see the total cash and cash equivalents, that stands at about 605 crores. This is excluding surplus funds in the form of investments and loans. I will come to that separately. If I move to the next slide. On the next slide, slide 21, this is the total financial position. As I said, shareholder funds of 7,820 crores, a book value of about 1,681. We have gross debt of 1,107 crores, and this was about 1,306 crores for the quarter as of March 24. So there is a reduction of about 198 crores between March and June. At a total net cash and treasury surplus, that is total cash net of debt, again, we are in a strong position. We have about 5,177 crores of net cash and treasury surplus as of 30th of June. And this is increased by about 164 crores compared to the position as of March of 24. Moving on to slide 22, this is the operating revenue split. Out of the 1,092 crores, CX services accounted for about 57%. Digital and media services accounted for about 43%. About 28% of the total revenues have come in from the media business, and about 15% of the total revenues have come in from our digital and technology services. Moving on to slide 23. If you see the pie chart on the left-hand side, this is revenue by delivery. India continues to be at 42%, and within that 42%, 28% of total revenues is coming from the media business, and balance 14% come from our HRO business and what we do from service international clients from India. US is at 20%. UK and Canada are in the range of 12 to 13%, and Philippines at 11%. If you look at the graph on the right-hand side, India accounts for about 36% of total revenues. That includes the media business, the HRO business, and the HRO business. In terms of origination, USA is at 30%, followed by UK at 15%, and Canada at 12%. Australia, which comes from the Diversify acquisition, that continues to do well. and now accounts for about 6% of total revenues. Moving on to slide 24, this is revenue by vertical. The technology, media and telecom account for about 55%. Public sector, which is primarily UK and some from Canada, account for 11%, followed by BFSI at 15% and consumer and retail at about 12%. Moving on to slide 25, the client concentration. As we have said earlier, the media business has multiple clients, so they don't really come in from an impact of a client concentration because it's primarily a B2C business, but with the broadband business picking up, we would see more to B2B business. The top client accounts for about 10%, client from the technology, media and tech sector. Top 5 account for about 25% and top 10 account for about 34%. So as you would see, the client concentration is fairly less, with top 10 accounting for only 34% of the total revenues of HGS. And we talked about it earlier. The DSO days have come down from about 62 days at March 24 to 60 days as of June 24. That's my last slide. We would now like to open the session for Q&A, and I would hand it back to the moderator to moderate the Q&A session. Back to you, Darshan.
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from Hina Parekh, who is an investor. Please go ahead.
Hello. Thanks for giving me this opportunity. I have 3 questions. First is on the other expenses. So I wanted could you just clarify the components that contributed to the increase in the other expenses in Q1 FY25?
Yeah. As I said, we are investing in some solutions for the subsequent growth of the business. And we've also incurred some costs relating to the severance cost, joining bonuses. So those are the kind of costs which are there, which I've said is one-time in nature.
Okay. Also on the other income, could you throw some light on the components included in the other income for this quarter as well as for the last quarter?
Yeah. So if you look at I'm looking at the consolidated numbers. We had about 114 crores of total other income, and out of which there was a component which had 159 crores for the quarter ended March 24, out of which about 50 crores came in from the profit from the sale of some fiber from the media division, and about 99.5 crores came in the form of interest income. And FX gain was actually a loss of about 6.4 crores. If you look at the similar numbers for Q1 of FY25, interest income has actually gone up to 102.3 crores. And there was an FX gain of about 8 crores compared to a loss of 6.4 crores the quarter ended March 24. So these are the 2 big ones which have changed. I would say the lack of profit from sale of the fiber assets, which resulted in the drop in the other income.
Okay. And just one last question. Can you please elaborate on the profits from discounted operations for this quarter? And will such gain going to persist in future as well?
So as I mentioned, we had sold off the healthcare business in January of 22. There was one payment which had been held back, and that payment came through in the month of during the current quarter. So taking into account the estimated expenses, we have recorded net profits of about 218 crores. So unless we are not expecting any major costs associated with this, unless it is something which would be related to the healthcare business, which we have to incur at a go-forward stage. For instance, if we have given some indemnities, and if those indemnities get invoked, and then if you have to make some payment, then you would incur those costs.
Right. Okay.
On an ongoing basis, we are not expecting any major cost in relating to the discontinued operation, because it's, by definition, something which you have discontinued. Clearly a one-off.
Okay, sir. Thank you so much, sir.
Thank you. The next question is from Harshal Patil, who is an investor. Please go ahead. Mr. Harshal Patil, your line has been unmuted. May I request you to go ahead with your question? Mr. Harshal Patil, your line has been unmuted. Please go ahead with your question.
Hello. Yeah, hi. Sir, I have a few questions on that regarding to Gen AI. One major IT servicing company mentioned that implementing the Gen AI could lead a productive improvement.
May I request you to use your handset, please?
I'm using my handset only.
So your audio is slightly muffled, sir.
Am I audible now?
Yes, sir. Please go ahead.
Yes. On Gen AI, one major IT service company mentioned that implementing Gen AI could lead to a productive improvement of up to 50% in some BPO services. What are your views on that, and what is the kind of ask from clients in terms of fast back and productive improvement today?
So I won't be able to quantify how much a productivity improvement can happen. It's very, very case specific. But yes, there will be a productivity improvement, which will end up our being able to automate more processes. So as I told you, we've been able to now develop capabilities by which we can design those automation processes using AI. So something that we are using people for will be done by technology, but we'll be paid for the technology services as well. So that is the way I see this thing playing out.
Okay. Can you put some light on the cash and the treasury surplus has increased from 5,013 to 5,177 crores. But could you provide clarity on this, like how this fund will be utilized?
Hi, this is Pala here. So Harshal, as I mentioned, we did receive funds from the sale of the healthcare business. So that obviously has added to the treasury surplus. Right. And these funds are being used, primarily we are looking at acquisitions. These would be in the space of digital analytics. We spoke about the company called TechLink, which we acquired a couple of years back. So we are looking, that was in February of 23. So we are looking for acquisitions in such space. And of course, a small portion would also go for growing the South Africa business, which is all organic. So that's what we are looking for in terms of growth of the business, either organically or through acquisition.
Okay. Can you shed some light on the decline in BPM business revenue and the margins in YOY and the QOQ business, and what we can see the business going further in coming quarters?
Yeah, I mentioned that there is a little bit of a slowness in demand. So as election uncertainties come in, we are seeing decision making getting deferred, and which is what's causing a slowness in demand. So we are hoping that things improve in the second half of the year. But as I said, it's something a little bit of uncertain at this point of time.
Okay. Thank you. I'll get back in the queue. Thank you.
Yeah.
Thank you. A reminder to all the participants, ladies and gentlemen, you may press star and 1 to ask a question. The next question is from Nikita Shah, who's an investor. Please go ahead.
Hello, am I audible?
Yes.
Yeah. So as we can see, media business revenue has grown Q1Q and Y-on-Y basis. Could you please tell me what this growth was driven by?
Sure. Nikita, this is Vince here. Can you hear me?
Yeah, I can hear you.
Okay. Yeah. So Nikita, if you recall, if you were there in the FY23 calls, one of the two, what we did was we paced ourselves out and we focused last year on growth. If you again recall, we said we wanted to grow our subscriber base significantly. We grew broadband by over 20-25%, nearly quarter of our business we grew last year, as well as we grew DTV, digital television, by about 8%. So the benefits of that growth, are being seen now in the consecutive quarters, because every growth obviously has a settling period attached to it. What do I mean by that? I mean, if you sign up tomorrow with me for broadband, what happens is that we give you a 6-month pack, and probably the first 30 days are free. So the revenue gets booked obviously later. So the kind of benefit of the revenues is coming later. And our entire focus in this fiscal, in FY25, is to focus on monetizing that growth, to focus on monetizing the customer base that we've grown, and therefore be able to take our revenues, which is why you've seen a significant growth in revenues year on year, close to about 35%. So I think that we're hoping to continue to push. We also are continuing to push profitability, and that we're slowly beginning to see not just green shoots, we're beginning to see a pretty significant improvement on that front as well, Nikita. I hope that answers your question.
Yeah, it does. So is this kind of growth sustainable in coming in future with 30-35% growth that we observed today?
So, Nikita, I'll put it slightly differently to you. I think it also depends on the focus areas we're on. So, our focus, for instance, in a particular quarter may be purely on subscription growth. Another quarter may be on revenue growth. A third quarter may be on profitability growth. So, we look at the opportunity that allows itself or that provides itself in front of us. To give you an example, wired broadband, as I mentioned at the start when I was talking, wired broadband has crossed barely 38 million homes, right? We're close to 300 million homes in the country today. The Prime Minister's vision for digital inclusion is very, very clear. And we believe that kind of growth, broadband growth, is going to continue to see significant amount of double-digit CAGR growth over the next several years as digital inclusion becomes a reality. So I think what we're doing is we're pacing ourselves, we're focusing on sustainable growth, and then we're focusing on sustainable profitability, and then looking at other areas that kind of that kind of comprehensively allow us to, stabilize ourselves and then take the next level of growth. So by and large, we've been doing that quite successfully for the last several quarters, and we hope to continue with that going forward.
Okay, that answers my question. I do have one more question. So if you observe, we have significantly increased the media segment liabilities for the quarter-on-quarter basis. So what could be the reason for this particular rise?
You're talking about the rise in the subscriber base or the rise in the revenues, Nikita?
Rise in the liabilities of the media segment.
The liabilities. Okay.
Yeah.
I'll leave that to Tala. Would you like to answer that?
Yeah. So there are certain assets which are on lease, and as per Ind AS 116, you will have to take assets on lease and create lease liabilities. So the increase in liability is primarily because of that.
Okay. Okay, that answers my question. That's it from my side. Thank you.
Thank you. Thank you, Nikita.
Thank you. Ladies and gentlemen, a reminder to all the participants, you may press star and 1 to ask a question. The next question is from Anuj Pawar from Family Office. Please go ahead.
Yes, hi. Thank you for the opportunity. Could you provide an update on the current order book and the orders in the pipeline, please?
Well, I think I've answered that question. The pipeline is fair, is the way to put it. It's not as robust that I would like it, and I would put that on the uncertainties on the macroeconomic factors and also on the uncertainties around the election outcomes.
Okay. And you had mentioned that the UK is performing better than expected due to the improved revenues. So which other markets are doing well? Like which ones are you targeting in the future?
Australia is also starting to do very well. So
Australia.
Yes.
Okay, got it. That was all. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from Praveen Sharma from Sharma Investments. Please go ahead.
Yeah, hello. Thank you for taking my question. I'm audible, right?
Yes.
Please.
Yeah, okay. So, considering your plans to incorporate AI into your system, could you explain how this might affect the attrition rate and provide an outlook for the future? That is one. The next one is, could you give a breakup of TechLink and Diversify business revenue and EBITDA?
So, can you repeat your first question?
So basically, when we take a look at your plan to incorporate AI into your system, could you throw some highlight as to how this might affect the attrition rate and provide an outlook for the future on this?
So look, I believe there is enough of slack in the system for us to be able to use AI to improve customer experience. You will be surprised to know that when you call a customer care line, mostly in the Americas, the typical hold time that you will find is about 15 to 30 minutes you're put on hold before somebody answers the call. So that being the situation, I believe that AI, when conversational bots are actually allowed or developed, will be able to cut down the wait time for consumers. So therefore, I don't see AI displacing human beings. I believe that the growth will happen together. It may slow down the growth for job growth, but it will not necessarily reduce the number of people that we have today.
Okay. So my other question was, could you just give a breakup of your TechLink and Diversify business revenue and EBITDA?
Yeah, we will give you that. Just hold on.
So as far as TechLink is concerned, it's in the range of about 8.3 million, and EBITDA margins are in the 20s.
Okay.
And in case of Diversify, it is in this similar range.
All right. And if I could just, sorry, go ahead. Sorry.
Revenues would be lower. Revenues would be more about 7.5, but margins are in the same range.
All right. Thank you. I just wanted to squeeze in one last question before I get done. Given your emphasis on attracting and retaining talent in the digital and tech domains, could we anticipate an increase in employee costs in the future?
That's a little hard to predict at this point of time.
Okay. That answers all my questions. Thank you so much and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. As there are no further questions, I now hand the conference over to the management for closing remarks.
Thank you very much for being with us in our earnings call today, and we look forward to having a similar session with you. at the end of quarter 2, which will be sometime in the middle of November.
Yes, thank you everyone. This is Vinsley, and also wishing everyone a happy Raksha Bandhan, and looking forward in the next call as well. Thank you again for your time today. Much appreciated. Tala?
Thank you.
Thank you, everyone. Thank you for joining us on this call, and happy Raksha Bandhan, and look forward to seeing you and discussing our Q2 results in a few months' time.
Thank you.
Thank you.
On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.